Welcome back, investors, to Ticker Time News. I'm Adam, and Alibaba, ticker symbol BABA, faces further selling pressure after posting its weakest quarterly growth rate since going public in 2014 by a wide margin. Regulatory crackdowns by the Chinese government may have initially sparked elevated concerns among investors, but a slowdown in sales across both e-commerce and cloud computing has created a snowball effect, sending shares down around 65% from all-time highs reached in October of 2020 and 55% over the past year. Now, before I dive into what went wrong with Alibaba, could you smash that like button, share this video, and click that join button right underneath this video's title to get our top 10 stocks list. And if it's your first time watching, click subscribe. Thank you, my friends, for doing that. Revenues for Alibaba in Q3 not only missed estimates, but climbed just 9.7% year over year. This single-digit quarterly growth rate was by far Alibaba's lightest since its 2014 IPO. It never saw rates dip below 20% over that time period. Also, even though growth jumped a healthy 36.9% in the same quarter a year ago, Alibaba had little trouble delivering about 30% growth in Q1 and Q2 despite lapping growth over 30% in each of those two quarters. The lackluster sales growth stems from multiple factors. For one, China's economy is still struggling from the pandemic. Total retail spending rose just 3% year over year in the quarter, a deceleration from the prior quarter. A sour economy drove domestic commerce sales of only 7% year over year, a single-digit gross merchant volume, or GMV growth. Meanwhile, international sales performed much better, growing 18%. And cloud growth was mild at 20% year over year as overseas demand fell. By comparison, cloud revenue grew by 33% in Q2 and 29% in Q1. Alibaba's cloud services were already impacted in December after the Chinese government regulators found a cybersecurity vulnerability. With overseas demand slowing, Alibaba's cloud segment may continue to demonstrate weakness going forward. A standout in the quarter came from annual active consumers, or AACs, reaching 1.28 billion globally, translating into 43 million net new ads. In China, AACs were up 3% quarter over quarter to 979 million, setting Alibaba on track to reach 1 billion AACs in China by the end of fiscal year 22. As a result, Alibaba noted that it is shifting its focus from new user acquisition to user retention and average revenue per user, ARPU growth. Looking ahead, Alibaba did not provide formal guidance, which is not easing growth concerns. Its commentary surrounding its near-term outlook was also vague. Alibaba stated that it expects China commerce GMV to remain resilient and cloud and international commerce to exhibit strong growth. We'll have to see about that one. Overall, Alibaba's troubles continued mostly unabated in Q3, with softening commerce and cloud revenues driving further selling pressure. Although Alibaba has been impacted by its government's investigations surrounding anti-monopolistic practices, so has most of the Chinese tech sector. Despite this, Alibaba's main rival, JD.com, and let me do this for you. Their ticker symbol is JD. I'm going to put a comparison up here of JD.com so you can see the difference. The orange line is JD.com, while the green and red candles going in this downward motion is Alibaba. There is a 6.92% difference as of today. So as you can see, JD.com has not faced the same magnitude of selling, as its shares have declined by less than 30% over the past year. JD's valuation of 7 times forward earnings is more attractive relative to Alibaba's 13 times forward earnings, which may also factor into less pronounced decline. Still, given Alibaba's weak Q3 results, JD.com could see similar figures when it reports Q3 earnings on March the 10th, 2022. Well, that's what I think about Alibaba's dismal earnings report. But what did you think about it? Let me know in the comments below, as your comments make these videos so much better. Smash that like button, share this video, and click that join button to get our top 10 stocks list. And if it's your first time watching, click subscribe. Thank you so very much for watching, and I'll see you in the next video.